Listen up, everybody. We need to have a serious talk about your money and Social Security. So many of you work your entire lives, diligently paying into this system. You see that FICA tax come out of every single paycheck. You think, okay, this is for my future. But then retirement comes, and you get a nasty surprise. The government can turn around and tax your Social Security benefits. It's like paying for a meal twice. Every dollar you pay in unnecessary taxes is a dollar you don't have for your security, dreams, and peace of mind. It's your money. You need to protect it. The problem starts long before you retire. While you are working, you pay Social Security payroll taxes on your wages. That's 6.2% from you, 6.2% from your employer. If you're self-employed, you pay 12.4%. That's a huge chunk of your cash. But the real kick comes later. Once you collect benefits, the IRS looks at your combined income. It's simply adjusted gross income, non-taxable interest you earned, 1/2 of your Social Security benefits for the year. If that number crosses thresholds, poof, up to 85% of benefits can be taxable. This is a financial tsunami for millions. You planned your retirement around a certain Social Security amount. Then you find out you owe federal tax on that money. It blows a hole in your budget. Less money for groceries, less for healthcare, less for visiting your grandchildren, less for keeping your home. It creates stress when you should feel secure and joyful. Denying this is the biggest mistake. You must be proactive about your financial future. We are not going to sit back. You are going to get smart and proactive. Knowledge is power. Understanding these taxes is step 1 to minimizing them legally. I'll walk you through clear, actionable steps to keep more money in your pocket. This isn't cheating, it's playing the rules to win. Your financial independence is on the line. The number 1 rule you must burn into your brain is this. Your income in retirement dictates whether your Social Security benefits get taxed. It is that simple. The enemy is the combined income formula. Let's look at the numbers for a single filer. Between $25,000 and $34,000, up to 50% taxable. Above $34,000, up to 85% taxable. For married couples filing jointly, $32,000 to $44,000, up to 50% taxable. For married couples filing jointly, above $44,000, up to 85% taxable. These numbers are ridiculously low and haven't been adjusted for inflation in decades. That is a disgrace, but it's the reality. So the solution is crystal clear. You must manage your income sources in retirement to keep combined income below those thresholds. This requires a strategy. You can't just stumble into retirement and hope for the best. Hope is not a financial plan. First step, identify all potential sources of retirement income. Pensions, part-time work, withdrawals from 401ks, withdrawals from traditional IRAs, interest, dividends, capital gains from selling investments. Each of these adds to your adjusted gross income and can trigger taxation of Social Security. You need to look at the whole picture. One powerful tool is deciding when to claim Social Security. You can start at 62, your check will be permanently reduced. Wait, and your benefit increases every year up to age 70. Delaying can be a brilliant move. In early retirement, say from 65 to 70, live off other money first. Withdrawals, savings, etc. That keeps your Social Security income at 0 for those years, making it easier to manage taxable income. Then at 70, you turn on a much larger monthly check for life. Pros and cons. Pro, bigger monthly benefit for life, helps avoid running out of money. Pro, gives a 5 to 8 year window to manage other income. Pro, opportunity to do Roth conversions later. Con, you need enough other savings to live on while you wait. If you're in poor health, your retirement accounts are not just piggy banks, they are powerful tax planning weapons. How you use them can make a massive difference in how much tax you pay on your Social Security. Let's start with the accounts you've been funding for years, your traditional 401ks, traditional IRAs. The money in these accounts is pre-tax. You got a tax deduction when you put it in, but the piper must be paid. Every dollar you withdraw from these accounts in retirement is taxed as ordinary income. Those withdrawals also count towards the combined income formula that can tax your Social Security. So a big withdrawal can be a double whammy: tax on the withdrawal and increased taxability of your Social Security benefits. Enter the Roth IRA. Roth 401k. A Roth is the opposite of a traditional account. You contribute after-tax dollars. No tax break today. But qualified withdrawals in retirement are 100% tax-free. Tax-free. Money from a Roth does not count as income. It does not go into the combined income calculation. It's invisible to the IRS for that purpose. You can pull a large sum from a Roth for a new car or for a big trip, and it will not make 1 penny of your Social Security taxable. Aim to get as much into a Roth as is legally possible. If most of your money is in a traditional 401k or in an IRA, you are not stuck. You can do a Roth conversion. Move money from traditional to Roth. There is a catch. The converted amount is added to your taxable income that year. So be strategic. Don't do a massive conversion in a high-income year. Do partial conversions in low-income years, especially between retiring and starting Social Security. Paying tax now at a lower rate buys you tax-free income later. That's priceless for managing your retirement tax bill. Roth pros: tax-free withdrawals. No required minimum distributions for Roth IRAs. Helps keep your combined income low. Roth cons: you pay income tax on conversions up front. You must have cash outside your IRA to pay that tax. Using IRA money to pay the tax is a terrible mistake. Follow the 5-year rule to make earnings tax-free. You need to become a master of timing. Many people accidentally trigger Social Security taxes because they aren't paying attention to when they receive large chunks of money. One of the biggest culprits is capital gains. Let's say you've owned a stock or a mutual fund for many years. It has grown in value. When you sell it, you have to pay capital gains tax on the profit. That profit also gets added to your adjusted gross income. That can push your combined income over the threshold and make your Social Security benefits taxable. It is a chain reaction you must avoid. The solution is to be deliberate about when you sell your investments. If you need to sell an asset with a large gain, try to do it in a year when your other income is low. For example, the year after you retire but before you claim Social Security can be a perfect time. Your income from work is gone, and your Social Security income hasn't started yet. Selling in that gap year could let you realize the gain at a lower tax rate and prevent it from affecting your benefits. Conversely, if you are having a high-income year, that is the worst time to sell a winning investment. Think like a chess player, planning your moves several years in advance. This logic applies to any large, one-time income events. Maybe you are selling a second home. Maybe you are receiving a final bonus. Maybe it's a buyout from your employer. If you have any control over the timing, use it to your advantage. Can you push that income into the next tax year? Or could you have received it the year before you started Social Security? Spreading large payments over multiple years through an installment sale can be a savvy move to avoid spiking income. Every dollar that pushes you over the Social Security tax threshold has a ripple effect beyond the initial income tax. Let's be clear about the trade-offs. The pro of careful timing is significant tax savings. The con is it requires planning and sometimes sacrifices flexibility. You might want to sell when the market is high, but if it's a bad tax year, you face a tough choice. Weigh potential investment gain or loss against the definite tax cost. A financial advisor can help analyze this. The key takeaway: never make a major financial move without first asking, how will this affect the taxes on my Social Security? That one question can save you thousands. We've covered a lot of ground, but it all comes down to this. You are the CEO of your own retirement. You must take control. Let's summarize your action plan. First, understand the problem. Your combined income can cause Social Security benefits to be taxed. Denial is not an option. Know the thresholds. Have a plan to stay under them whenever possible. This is active and ongoing throughout retirement. Start by projecting income from all sources. Incorporate the tools we've discussed. Use retirement accounts wisely. Build up a Roth IRA or Roth 401k. Be strategic with Roth conversions in low-income years. Master the art of timing. Plan sales of assets and timing of lump sums. Consider delaying Social Security to age 70 if you can. Married or self-employed. There are extra strategies. Married couples. Coordinate claiming decisions to minimize joint tax. Self-employed. Explore deductions and consider S-corporation structure for payroll tax savings. These are complex decisions. Stop and seek professional help. A tax advisor or financial planner is an investment. Rules change. Your situation changes. This is not set and forget. Review your strategy every year. Look at income and tax laws. Make adjustments. Taking control of Social Security taxes is empowering. It's about being strong, smart, and secure. Do not leave this to chance. Start with one step today. Calculate your combined income. Look into a Roth IRA. Make a call to a financial professional. Take action now. You have worked too hard for your money to simply give it away in unnecessary taxes. Let's get started. Thanks for watching. Don't forget to subscribe for more tips.